Hello everyone, my name is Almas and this is the first episode of my educational series where I talk about the investing mistake that I did during my investment journey. This first episode will be primarily dedicated on dividends because the dividends companies are the first mistake I ever did when I just started investing around 5 years ago. So a little bit about myself. As I already said, I've been investing for almost 5 years. I live in Canada, and as most Canadians, when I just started, I only invested primarily in a Canadian dividend stocks, or as everyone else does, Canadian big banks that paid their dividends for almost 100 years. Before talking about dividends, I wanted to talk a little bit about why companies goes to initial public offering, or why companies go into the public so that anyone in the world can buy their stocks. And understanding this will help you to understand what are the dividends. So let's start with this. The reason why companies go to IPO is because they need cash. So when companies need cash, they have two options. They can either go to a bank, get a loan in order to, let's say, expand, create new manufacturers, hire more employees, invest into the research and development. But as a loan, they will have to repay it. So let's say they open the new factory and the factory's payout period will be like 5-10 years, but they also have to pay the loans within a few years. So the getting a loan from a bank is not really flexible. Another option for all the companies is to go into the initial public offering, which means they sell their shares of their company, which means that anyone in the world can buy a fraction of the share. In return, the shareholders will give their cash into the company, and the company is free to invest this cash wherever they want. So they will hire more employees, they will open more factories, they will try to create more products, and as a result, it promises you that in the future, this company will worth a lot more than it worth today. So you are paying in order to increase your money in the future. So what happens if all of this will be reality? The company uses your cash, they expand it, right? So now they don't need the cash anymore. What do they do instead? So what they can do, they can first buy back their own shares, which means that the company will go into the public market, buy their own shares, and then cancel it. And as an example, I really think about as a pie. So let's say there's a pie with 10 pieces and you own one piece of this pie. It means that you own 10% of the company. Now let's say the company goes to the public market and they buy 2 shares out of the 10 and then they cancel it. So now the total number of shares of this company is 8. And you, as you own only 1 share, now own not 10% but 12%, which means that the price of your share will increase because now you own a bigger pile of this pie. The second thing that the company can do with their excessive cash is they can try expanding. So they can buy another companies. They can spend more money and resources on research and development. And this is what happens with the companies such as Google, Adobe, Meta. They are spending a lot of money in order to come up with new products, in order to find the new markets where they can expand. The last thing that company can make with excessive cash is pay to their shareholders. So in a situation when company doesn't know what to do with the cash anymore, and instead of paying for new companies, which might not result in a good return on investment, they can just decide to give this cash back to their investors. So this is what is called the dividends. The dividends is a payment that the company makes to their shareholders. One important thing to remember, when company earns money, they are paying taxes. And dividends are the money they pay to their shareholders after tax. So if company earned $1 million, paid $500,000 as a taxes, they end up with a $500,000. And out of those $500,000, they will pay, let's say, $300,000 to their shareholders. You as a shareholder, when you receive the dividends, you will have to pay the taxes again. So all the dividends are taxed 2 times. I don't know how it works in other parts of the world, but this is how it works in North America. So keep it in mind. One more thing that I want to emphasize is that the share buybacks, or going back to my example with the pie, is a tax-free. So if company goes to the public market and buy back their own shares, you don't have to do anything. It's just a matter of time when the share price will increase because there are less shares in the market. Not many investors know, but when a company pays the dividends, the share price in the public market goes down. And this is a little bit confusing, so I'll try to emphasize this part. So again, when company pays the dividends, the share price goes down to the same amount as the company paid the dividends. So for example, if you invest in a company like Enbridge in Canada, and the Enbridge share price is at 50 Canadian dollars per share, the Enbridge pays dividends every quarter. So their usual dividends is around $2, and as soon as Enbridge pays $2 to their shareholders, the share price will decrease from 50 to 48. This might be confusing for new people, but it actually makes sense. So think about it. The Enbridge as a company, let's say it's worth $1 billion. And Enbridge has around, let's say, $100 million in their bank account as a cash, right? And now think about this. They take the cash out of the bank to pay down as a dividends to their shareholders. Think about it. Will you pay more for Enbridge when they have $100 million in the bank account? Or will you pay less when Enbridge has only $50 million worth of cash in their bank account? Of course, you will pay less. So this is the primary reason why the company stock goes down when they pay dividends, because now the company is worth less than they used to. And there are a quote from the Peter Lynch, and he says that dividends is just the money transfer from one bank account to another. So basically, you as a shareholder, you are just getting a bit poorer when the company pays dividends, and they just send the dividend from their bank account to your bank account. But you as a shareholder, you just end up with the same amount of money. So if the company were to just keep this cash in their bank account, the stock price will be the same. But if they pay this cash to you, the company worth will be less. Now I want to talk about who is paying the dividends. Most of the time, those are really mature companies. Big companies that used to be in the market for 100 years or centuries. They started as a small companies with one vision to, for example, take this search market as a Google did, or take the beverages market as Coca-Cola or Pepsi did. Today, those companies are big, mature. They don't need to reinvest into the companies. In my core holdings, most of the companies, they are not paying dividends. Those are small companies. They just started. They are spending all the cash they have into the research, into the advertisement, into bringing more customers. They don't have excessive cash that they can return to their shareholders. Moreover, if one of those companies started paying dividends, for example, Upstart, I will sell all of my shares because I, for example, don't believe that paying down dividends to shareholders matters at this specific time when the company is still small. So for me, it will be a big red flag, which means that the company doesn't know what to do with their cash anymore. So they decided to just give this cash back to me. So after all of this, after knowing that the company's share price drops at the same amount as they pay the dividends, you might have a question: who will invest into the dividend companies? So I started investing in dividends myself because it feels good when you open your brokerage account and you see some cash going on into your account that you can spend, that you can withdraw and buy something. But as I said, those companies are already mature, right? So their upside is not as big as something like a small cap. But there are some people that still will benefit from investing into the dividend companies. One example is retirees. They have a lot of cash. They put it into something stable, like a bank, like JP Morgan, or like utility or energy stock. Those companies are already big enough, so they will pay you back in dividends every year, and you can live off of those dividends when you're a retiree and you don't have another source of income. But as a young investor, if you have 30, 40 years before you retire, it doesn't make whole sense to invest primarily into the dividends because your total return will be a lot lower comparing with if you invested in the non-dividends paying companies or in a company that pay a really small dividend. Don't get me wrong, I don't want to discourage you to invest in dividends companies because there are a lot of companies that are paying growing dividends. For example, Microsoft. Microsoft increased their dividends for the last 10 years with an annual rate of 10%. So every year, Microsoft grows their dividends by 10%. Why? Because their earning grows. They have more excessive cash. And what do? They return this cash to their shareholders. What can go wrong with a dividend investment? And this is one of the mistakes that I did in one of the companies that I had in my portfolio 4 years ago, and I will talk about it a little bit later. So let's say the company is in a downtrend. Let's say it's cyclical, it's an energy stock, it's a oil company. The oil price goes down, which means the earning of this company is also going down. So as dividends is excessive cash that company pays back to their shareholders, now they don't have this excessive cash because the oil price is really low. What company will do in this situation? So there are two ways. One, the management comes to public market and say, the earnings are going down. It makes sense to pay the dividends. We better just keep this cash in the company just in case the oil price will go even lower. Another thing is the company will say that the earnings are going down, but they believe the dividends are sustainable and they will keep paying you the dividends. But they don't have the cash to pay you. Where do they get it? They get it by getting loans from a bank. And this is a worse scenario. The company goes to the bank, they take a loan. They don't invest this loan into the company, they just pay it all back to their shareholders. Why it happens? Usually people who get used to getting their dividends from this company, they will get afraid if the company is not paying the dividends anymore, or if they are paying less dividends. As a result, people will be selling the stock. The selling pressure will make stock price goes down. And for any CEO of any public company, the stock going down is a bad sign. Usually their compensation is based on the stock performance. If stock performance is bad, the CEO compensation will be really bad. And during the next tenure, people on the board of directors might vote to choose another CEO because the stock price went down. So some CEOs will do everything to keep their share price as high as they can, even though it means taking the loan that the company can't pay in the long term. Another thing is some companies that have been here around for many decades, they have been paying dividends all the time. And if you are the ETF investor, you might know some ETFs such as Schwab SCHD, which is the growing dividend companies, such as JP Morgan, such as some energy, banks, utility stocks. But 1 year the company stopped paying dividends because they can't afford it anymore. So what the committee will do, they will exclude this company from the ETF, which means that they will have to sell it. And again, the stock price will go down. So for companies, it makes sense to be in the index even longer. So in the end, I just want to emphasize a few key metrics that you need to keep in mind when investing in a dividend companies. One of those metrics is the dividend yield. And you can see the dividend yields in any website that shows you the stock price, like Yahoo Finance. The dividend yield is the amount of dividends a company pays divided by the share price in a percentage. The higher the yield, it means the more money you'll get from the dividends, but at the same time it means the lower the share price. And usually if share price goes down, the yield going up. And the reason the share price goes down is because market knows that the company is not able to pay their dividends anymore. So keep in mind, a high yield is not always good in a percentage. Another important thing is called the payout ratio. The payout ratio is a percentage of the free cash flow that the company earns distributed as a dividend. So let's say the company earned 1 million, and out of those 1 million, they paid down dividends with a value of 700. So it means that 70% of this earning were distributed as dividends. The higher this number is worse, because it means that the company is paying everything they have as a dividend. Sometimes this number can be even more than 100%. For example, Enbridge. Last year they paid with a payout ratio of 140%, which means they distributed all of their earnings, plus they took a loan from a bank to pay down the dividends. So in the end, don't blindly buy a company because it pays dividends. Always do your research. Check how much they pay from their earning. Can they afford the dividends? And are you even good investing in this company even though the dividends are stable? or you want a higher return, and instead you should invest in a smaller cap company which is still growing. Thank you, everyone. If you have any questions, please leave them out in the comments. I will try to answer everything I can.